Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Welcome to episode 10 of the Breaking Into Finance podcast. Today, we are going to review one last example on the three financial statements. And at this stage, I hope you're building some familiarity with the interconnectedness between the three statements. This episode emphasizes the relationship between balance sheet, statement of cash flows, and we're also going to talk about the tax impact of some things like debt borrowing. I would also recommend having a pen and paper handy to keep track of some of the numbers to ensure that you're able to follow along. Now we're going to revisit a topic that we started the day with, which is talking about the cash flow statement. And in our first example, we spent some time talking about what happens if a company raises some money by giving away equity. So in this example, we're talking about a business that is where the equity value is worth $1,000. And we are giving away 10% of our equity in exchange for $100 that we're adding to our balance sheet. And in this example, our total equity value on our balance sheet goes up by $100. This goes into a line item that might be called common stock or whatever form of shares we used to raise the equity. It does not impact retained earnings critically, which is another line item that we've talked about previously in the equity component of the balance sheet. And our assets also go up by $100 because we now have $100 of cash that went to the company for their balance sheet. Meanwhile, liabilities are unchanged. I want to talk about another example now, which is what happens if the company borrows some money. So now they're taking out a loan. And I want to talk about what's happening in the first year of this loan. So now I want to use, the same example, the same company that's worth $1,000. Now they borrow $100 worth of debt and they get $100. And we're going to use a 6% interest rate again. Do you think that borrowing that money, first, let's talk about the balance sheet. Does it affect the balance sheet? And if so, how?
I believe it does affect the balance sheet because it affects your liabilities, which therefore affects the balance sheet.
Yep, absolutely. And so we have liabilities, and that's exactly as you would suspect when we're talking about debt. Debt is a component of the liabilities section of the balance sheet. Is there any other impact to the balance sheet for this loan? And this is on day zero. This is like the second you sign the contract and get the money.
Okay. I believe there's not any other.
Okay, so would the balance sheet, assuming the balance sheet balanced before you borrowed the money.
Okay.
And we just said we added $100 of long-term liabilities. If we do nothing else, sounds like our balance sheet.
Oh, then yes, our balance sheet is not balanced. Okay.
So how do we balance our balance sheet? Did you get anything when we agreed to this loan?
I mean, technically you get $100, but
you get the cash.
Okay.
You get the cash. Exactly. So long-term liabilities plus 100, cash balance plus 100. Now I want to, and that is a lot like the equity scenario. But now I want to talk about in the first year of this loan. This is a $100 loan that pays 6% interest. Okay. In this first year that we've had the loan, let's talk about our income statement first. Is there anything on the income statement that is impacted by the existence of this loan for a year?
Well, wouldn't that 6% impact?
Absolutely. Yes. And by the way, that's not totally obvious. It's sort of a funny thing to appear on the income statement, but it does. And the number one reason why it does appear is that under the US tax code, interest is tax deductible. And what that means is if you hear anybody use the term tax shield or tax deductible, that basically means that when you borrow money and you pay interest on that money, the interest that you owe can sort of count as a form of expense that can reduce the taxes that you owe.
So interest can reduce taxes?
Yes. Yes. So nothing else changing about your business. If you borrow money that accrues interest, or where you have to pay the interest, you can reduce the taxes that you owe just by virtue of having that interest.
Okay.
There is a line item right before you figure out your profit, which is your taxes. And so if we're trying to conceptualize what our income statement might look like, at the very bottom, we'll have net income. Right above that, we'll have our tax expense. And so the line item before that is earnings before tax. We need to know what our earnings is before tax, which you might see abbreviated as EBT, earnings before tax. The operating profit of the business is commonly also referred to as your earnings before interest and tax. And so this is the point where our loan shows up on the income statement. We have our operating profit, which is our earnings before interest and before taxes. You'll see where I'm going with the letter math here. EBIT is earnings before interest and tax, which you'll hear people say the word EBIT or EBIT. So if we want to get to our E, which is our earnings, we have to start with our EBIT. Then we have to layer in the interest expense to get to our EBT, which is earnings before just tax. Then we add the taxes, and then we have our earnings before nothing. So it's just our earnings. And so what would our interest expense be in the first year? We borrowed $100, 6% interest rate.
I want to say it's $106, but I feel like that's incorrect. Is it just 6?
It's just 6.
Okay.
Yeah. So let's assume that this company has let's call it a 33.3 repeating percent tax rate, because I want the numbers to work out. We have $6 in interest expense. How do those $6 in interest expense affect our net income, given that there is a 33% tax rate that this company pays?
Well, I know we said that if a company accrues interest, it like makes their taxes lower. So wouldn't that $6 bring that like 33% down, or no?
The 33% doesn't go down,
Okay.
but the 33% is applied to 6 fewer dollars.
Oh, okay.
Which is to say, if there was no tax shield, your $6 of interest expense reduced your net income by 6. But there is this tax shield. And so if we can avoid paying a 33% tax rate on this $6 of interest expense, that means that basically we only owe taxes, or our taxes are only impacted by $4.
Okay.
So let's say, and this is kind of confusing, and I imagine for listeners, if you're like trying to follow along. So let's put some numbers to this. Let's say our EBIT, our earnings before interest and tax, was $106. So if there was no debt on this business at a 33% tax rate, and I'm just going to pull up Excel here, and I'm going to say that our $106, we owe 33% taxes. And I'm just doing this on a calculator. So it's basically $35 in tax that we owe. But we actually now have this interest. So instead of owing $35 of tax, which is $106 of earnings before interest and taxes times 33%, we're not saying that our like tax basis is $106 of income. It's only $100 of income.
Okay.
Right? Because we have $6 of interest expense. So our earnings before interest and taxes was 106. Our interest is 6. So our earnings before taxes is only 100 now.
Okay.
And 100 times the 33% is 33. So we basically, if we had $106 of earnings before tax, which we would if our interest was 0, we would owe $35 in tax. But we only now owe $33 in tax. So we saved $2 in taxes by virtue of having this $6 of interest expense.
Okay.
At this 33% tax rate.
Okay.
You sound unconvinced.
No, it makes sense. So our earnings that we brought in were 106.
Our earnings before interest and taxes. Our EBIT.
Okay.
Yes.
Yeah. Our EBIT. And then the only reason why that $6 isn't taxed is because that is going to go into like our interest.
Exactly.
Like
that we have $6 of interest expense, which we're allowed to call an expense, which reduces our earnings before tax.
Oh, okay. That makes sense.
That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.